Most people think gold and silver prices move naturally. But what if I told you that for decades, these markets have been heavily influenced by something most investors don't even understand? What if the price drops you see are not real weakness, but controlled moves designed to shake you out? And more importantly, what if right now, we are getting very close to a turning point where physical reality will overpower paper manipulation? Welcome to Gold Silver Scope, where we break down the truth behind gold and silver in the simplest way possible. At the beginning of the year, it was expected that gold and silver would see a pullback. And that's exactly what happened. But this was not just a normal correction based on demand and supply. A big part of this move came from something called paper selling. This is when large players sell contracts instead of real metal, creating pressure on prices without actually delivering physical gold or silver. This system has been in place for a very long time. Since the early days of modern futures markets, traders have used paper contracts to influence prices. Over time, this became more advanced, especially after major financial events, where institutions realized they could control market direction using derivatives. Instead of reacting to the market, they learned how to move the market. And this is where things become important for you as an investor. Because when you see prices falling, it does not always mean demand is weak. Sometimes it simply means large financial players are pushing prices lower temporarily. We have even seen real-world proof of this behavior. Major financial institutions have faced penalties for manipulating markets, especially in silver. This shows that price movements are not always organic. There are forces behind the scenes that try to control direction in the short term. Now, here's the key point. Even after this correction, the opportunity has not disappeared. In fact, for many investors, this pullback has created a better entry point. The same ounce of silver that was expensive before is now available at a significantly lower price. That is how smart money operates. It waits for corrections, not headlines. But the bigger story is not the short-term price. The real story is the difference between paper markets and physical markets. Paper markets are based on contracts, promises, and leverage. Physical markets are based on real metal that people actually buy, hold, and use. For years, the paper market has controlled the price. But this situation cannot continue forever, because at the end of the day, real demand matters more than paper promises. And right now, the physical silver market is showing something very important: a consistent supply deficit. Every year, more silver is being used than produced. This creates pressure that slowly builds over time. And here's something simple but powerful. You cannot keep prices low forever when there is not enough physical supply. This is why many analysts believe that once this current phase ends, the market could move quickly, not slowly, but sharply. Because when the pressure releases, prices adjust fast. So the real question is not whether gold and silver will move, but when the market will stop listening to paper and start reacting to reality. And when that moment comes, it usually surprises everyone. When we move beyond short-term price action and start looking at the deeper structure of the market, one thing becomes very clear. The real strength of gold and silver does not come from trading charts. It comes from physical demand. And right now, that demand is quietly building in the background, while most people are distracted by daily price movements. There is a major difference between what people see on screens and what is actually happening in the real world. The prices you see every day are mostly driven by paper contracts. These contracts represent promises, not actual metal. In simple terms, many more ounces are traded on paper than physically exist. This creates an illusion of supply, which can keep prices lower than they should be. But the physical market tells a completely different story. Silver, in particular, is facing a serious supply issue. Every year, the world consumes more silver than it produces. This is not a one-time event. It has been happening consistently, creating what we call a structural deficit. Over time, this deficit becomes impossible to ignore. Think of it in a very simple way. If a product is being used faster than it is being produced, eventually there will be a shortage. And when that shortage becomes visible, prices do not adjust slowly. They move aggressively because the market suddenly realizes the true value of the asset. This is why the idea that you cannot short a shortage becomes so important. It means that while paper markets can push prices down temporarily, they cannot create real supply. At some point, physical buyers step in and absorb the available metal. When that happens, the power shifts from paper traders to real-world demand. Another important factor is timing. Markets do not move in straight lines. Even in strong long-term trends, there are corrections, pauses, and periods of frustration. This is exactly what we are seeing right now. A pullback does not mean the trend is over. In many cases, it simply resets the market before the next move higher. Many investors make the mistake of buying at the top and selling during corrections. But experienced investors understand that corrections are part of the process. They use these moments to position themselves, not to panic. Looking ahead, the expectation is that once this correction phase is fully completed, the market could begin a new upward move. And this move may not take years to start. It could happen much faster than people expect because the underlying conditions are already in place. Now let's talk about something even more important than price: risk. Most people think risk means price going down. But in reality, the biggest risk today is not volatility. It is counterparty risk. This is the risk that the system you depend on may fail. When you hold assets inside the financial system, there is always another party involved. It could be a bank, a broker, or an institution. Your access to your wealth depends on their stability. If they face problems, your assets can be affected, even if the asset itself is valuable. This is where gold and silver become different. Physical gold and silver do not depend on any institution. They do not rely on a promise. They are not someone else's liability. They simply exist as real, tangible assets. In a world where financial systems are becoming more complex and more fragile, this simplicity becomes extremely valuable. Because when uncertainty increases, investors start looking for assets that do not depend on trust. And this is exactly why gold and silver have always played a special role throughout history. Not because they move fast, but because they remain stable when everything else becomes uncertain. The current environment is slowly moving in that direction, and the signals are already there for those who are paying attention. Now let's go deeper into the bigger picture, because understanding gold and silver is not just about supply and demand. It's about understanding the entire financial system. And right now, the system itself is under pressure in ways most people don't fully realize. The modern financial world is built on one main foundation: debt. Governments depend on debt, corporations depend on debt, and even everyday economic activity is driven by borrowing. For many years, this system worked because interest rates were low and money was easily available. But that environment is now changing. When interest rates begin to rise, the entire system starts to feel stress. Why? Because higher rates make debt more expensive to maintain. Loans become harder to service, and the pressure slowly builds across the system. It doesn't break overnight, but it weakens step by step. Think of it like a structure built on a thin base. As long as conditions are easy, everything looks stable. But when pressure increases, cracks begin to form. And once those cracks reach a certain point, the system cannot hold itself together the same way. We are already seeing early signs of this stress. One of the biggest warning signals is coming from areas like private credit and commercial real estate. These are parts of the market that do not always get attention in the headlines, but they are extremely important behind the scenes. In private credit markets, there are situations where investors are no longer able to withdraw their money freely. In simple terms, people who want their cash back are being limited or delayed. This is a very serious signal because it shows that liquidity, the ability to access money, is starting to tighten. And this is exactly how larger problems begin. It doesn't start with a full collapse. It starts with small restrictions, small delays, and small cracks that slowly spread. Once confidence is affected, the situation can escalate quickly. We have seen similar patterns before in financial history. Early warning signs appear, but they are often ignored because the system still looks stable on the surface. Then over time, those small signals turn into major events. At the same time, rising bond yields are creating another layer of pressure. Bonds are a core part of the financial system. Banks, insurance companies, and large institutions hold massive amounts of bonds as part of their portfolios. But when interest rates rise, bond prices fall. This creates losses on paper that can become real problems if the situation continues. Even major institutions are not immune to this. When the value of their assets drops while their obligations remain the same, their financial position weakens. This is how stress spreads from one part of the system to another. Now here's where gold and silver come back into the picture. Unlike financial assets, they are not tied to debt. They do not depend on interest rates. They do not rely on someone else's promise to pay. This makes them fundamentally different from most assets people hold today. In a highly leveraged system, where everything is connected and dependent on debt, assets that are independent become extremely valuable. Because when the system faces pressure, people naturally move towards safety. Another important concept to understand is access. Many people assume that their money, stocks, or investments will always be available when they need them. But in times of stress, this is not always the case. Restrictions can happen, withdrawals can be limited, transactions can be delayed, and even if access is available, values can drop significantly during a crisis. So the issue is not just whether you can access your assets, but what they are worth at that moment. This is why physical ownership becomes important. When you hold something directly, without relying on a third party, you remove many of these risks. You are not dependent on a system that may be under stress. The world is not ending tomorrow, and these changes do not happen instantly. It is more like a slow process, a glide path where conditions gradually shift from stable to unstable. But those who understand this process early are in a much stronger position than those who react late. And right now, the signals are becoming clearer. The system is not breaking yet, but the pressure is building. As we move closer to understanding the full picture, one of the most important things to realize is that financial systems do not fail all at once. They weaken slowly, then suddenly. And during that slow phase, most people remain unaware because everything still appears normal on the surface. Right now, one of the biggest hidden risks in the system is something called counterparty exposure. This simply means that your financial security depends on someone else fulfilling their obligation. It could be a bank holding your deposits, a broker holding your stocks, or an institution managing your investments. In normal conditions, this system works smoothly. But in times of stress, this dependency becomes a major weakness. Because if the institution fails, delays payments, or restricts access, your wealth is directly affected. Even if your investment decision was correct, this is not just a theory. The legal structure of the financial system has evolved in a way that many people do not fully understand. When you deposit money in a bank, technically you are not just storing it, you are lending it. The bank uses that money, and in return, you have a claim. But that claim depends on the bank's ability to operate normally. The same applies to brokerage accounts. When you hold assets through a broker, those assets are part of a larger system. In extreme situations, access to those assets can be delayed or restricted. Most people never think about this risk. because they assume the system will always function as expected. But history shows that during financial stress, rules can change, access can be limited, and confidence can disappear quickly. And once confidence is gone, the system becomes very difficult to stabilize. Another layer of risk comes from the idea of insurance within the financial system. Many investors believe that their assets are protected through various guarantees or safety mechanisms. But the real question is, who is backing those guarantees? If a small institution fails, it can be supported. If a few companies face problems, they can be managed. But if the entire system comes under pressure at the same time, the ability to support everything becomes very limited. This is where systemic risk becomes real. Even instruments that are designed to provide protection, such as financial insurance products, rely on someone else's ability to pay. And in a large-scale crisis, that assumption can break down. Protection only works if the provider of that protection remains stable. Now compare this to physical gold and silver. These assets do not depend on any institution. They do not require a counterparty. They are not based on a promise or a contract. Their value does not come from someone else's liability. They simply exist as real assets that you can hold directly. This is why they are often described as a form of financial insurance that does not depend on the system itself. In uncertain times, this independence becomes extremely valuable. There is also a psychological side to all of this. Financial systems are built on trust. As long as people believe everything is stable, the system continues to function. But when that trust starts to weaken, even slightly, behavior begins to change. People start asking questions, they become cautious, they try to access their funds, and this shift in behavior can accelerate problems that were already building in the background. We have seen this pattern before. Small signals appear first: limited withdrawals, delayed payments, unusual restrictions. Then gradually, these signals grow into larger concerns. And by the time the majority reacts, the situation is already advanced. Right now, we are in that early stage where signals are visible but not widely understood. The system is still operating, but the underlying stress is increasing. And this brings us back to the core idea. Gold and silver are not just investments. They are a form of protection against uncertainty, not because they are perfect, but because they are independent. In a world where everything is connected and dependent on debt, having something that stands outside that system creates balance. And as risks continue to build, that balance becomes more important than ever. As we bring everything together, the most important thing to understand is this. Gold and silver are not just about making profits. They are about protecting your wealth in a system that is becoming increasingly fragile. We started by looking at how prices are influenced by paper markets, where large players can push prices up or down in the short term. Then we moved into the physical market, where real demand continues to grow, especially in silver, which is already facing a supply deficit. After that, we explored the bigger picture, a global financial system built on debt, now under pressure from rising interest rates and weakening stability. And finally, we looked at the risks inside the system itself: counterparty risk, restricted access, and the reality that most financial assets depend on institutions staying strong. When you connect all of these pieces, a clear picture starts to form. The world is not collapsing overnight. This is not about panic or fear. It is a slow process, a shift that happens over time. But history shows that when these shifts reach a certain point, they can accelerate very quickly. And those who are prepared early are always in a stronger position. Gold and silver stand out in this environment for one simple reason. They do not depend on the system. They do not rely on debt. They cannot default, and they have held their value across generations. While everything around them changes, they remain consistent. This is why many experienced investors do not see them as just another asset. They see them as a foundation, something that provides stability when everything else becomes uncertain. Not something to trade every day, but something to hold with confidence. At the same time, it is important to stay realistic. Gold and silver can be volatile in the short term. Prices can move up and down, sometimes sharply. But that volatility is often misunderstood. It is not weakness. It is the market adjusting to changing conditions. Over the long term, the real story is not metals going up. It is currencies losing value. Gold and silver simply reflect that change. They act as a measuring tool, showing how purchasing power is shifting over time. Looking ahead, the conditions we discussed, supply deficits, rising debt pressure, and increasing financial risk, are not going away. In fact, they are likely to become more visible. And as they do, more capital will begin searching for assets that are safe, real, and independent. That is where gold and silver come in. Not as a trend, not as hype, but as a long-standing store of value that has survived every financial system before this one. If you found this breakdown helpful and want to understand gold and silver on a deeper level, make sure to follow Gold Silver Scope for more simple and powerful insights.